value of your securities fuels the ego, makes you feel like a big deal. But income fuels the yacht. The S&P is at the same level as it was in October. The NASDAQ is where it was in September, and the Dow is below where it was at the beginning of the year. My portfolios are still generating the same amount of income. Say you have $100,000, and it looks pretty when the market goes up, and you're losing sleep when the market goes down. As soon as I get you invested, you're going to start getting monthly income. Weren't they making enough money to pay their shareholders? I'm an owner. Pay me. You're using my money. And so that was my key element.
This is the Relentless Pursuit of Winning podcast, where we are here to educate, equip, and inspire people to build extraordinary companies. We're so glad you're here. Don't forget to like, subscribe, and hit the bell so you can get updates every time we drop a new episode. Now, let's get it started. This is the Relentless Pursuit of Winning podcast. My name is Rick Meekins. I'm your host today. And in our studio, we have Steve Selengut. How are you, sir?
I'm fine. Couldn't be better.
Couldn't be better. I love that. Yes, today on our show, we're going to be talking about finance, retirement, and all that cool stuff. So hold on. If you don't mind, if you haven't done already, I would love it if you'd like, subscribe, hit the bell so you get updates every time we drop a new episode. And without further ado, let's get it started. So Steve, you've got an amazing background. You've done some really cool stuff. Give our audience a little bit of who you are, what you do, and why you do what you do.
Okay, I'll try to keep it short. I started investing when I was 25 years old. I was very fortunate. You've heard the expression, choose your parents well. So I did. And when I was 25, the dollars that they had prepared for, like a Ivy League education my brother had, I chose to go to a small school in the middle of Pennsylvania and be a wrestler. And so I didn't spend all that money. So it all came to me when I was 25, and not in the form of cash, but in the form of stock certificates. I don't think you're old enough to have ever seen a stock certificate, but there used to be actual pieces of paper that were printed up by companies. So you'd have a certificate that told you that you owned 100 shares of IBM or something like that. Anyway, so I got all this. And the instructions were pretty simple. My father said, "Here you are, kiddo, don't lose it." So I had to learn all, I had a college education. I was in a business major. I was in a, not a management position, but a good position. And I knew a little bit about this stuff, but I never had actually managed an investment portfolio myself at that time. So I had to learn about what are stocks and bonds. I had a good idea, how they travel in price over time, how they are impacted on by various things. So I got it started. And I developed a system that I found that a way of judging the quality of the investments to me was how much they paid me in dividends. If they didn't pay me, why didn't they pay me? Weren't they making enough money to pay their shareholders? I'm an owner. Pay me. You're using my money, And so that was my key element. And the company had to be profitable to pay you a dividend. So that was a good quality test. So all of these certificates, all these stocks I had were of that nature. So the next thing I noticed, and my broker actually at the time, she and I studied the charts. And even if today, if you look at a chart of any stock on the New York Stock Exchange, up and down, up and down, up and down. Well, you can make something of that. They're not going out of business. They're raising their dividends occasionally. When they go down in price, you buy them or you add to your existing holdings. When they go up in price to a certain target, you sell them. Just like you were running a store. You got inventory on your shelves. You set a markup. Customer comes in. I'll pay you $10 more than it cost you. You got it, baby. That's it. And you did that. And I treated these companies, ownership, these shares of ownership, just like merchandise. I didn't want to see the value of my inventory go up and down. I wanted to sell it and add more inventory. And so eventually I had this wide array of companies, literally hundreds of them, that paid me dividends, that occasionally would go up in price. I would sell them. I would buy one of the other ones I just sold. I would add to some of them and so on. So I built an income machine, an income engine, so to speak. And eventually, by the time I was 34, I was making 4 times my salary in New York City. 4 times. Why am I commuting to New York City? Sandy, tell me, why am I doing this? I'm making more money than they're going to pay me in the next 4 years. I don't need them anymore. And the next question was, we've got a lot of friends that I can do this for. And I said, I'm going to start a business. So I started a business. I showed my friends, this is my investment portfolio. This is the amount of income it earns. Let's look at your investment portfolio and see how much income, how much money you could use to go to the British Virgin Islands with me or to go somewhere else. How much money could you spend without touching any of that principal? And they say, yeah, you're right. It's not making any money. They don't pay any dividends. So I started a business. I started managing money for people. Over the years, I grew the business to, I was managing by myself, my own business. The most I ever had was two employees. In the last 10 or 15 years, it was just my wife and I. And I was managing 110 million for people. And what I would tell them, it was mostly word of mouth, because in the financial services advisory business, you really can't advertise and say what your performance is and stuff like that. You just can't do it. And so it was all word of mouth. But I used to tell the clients that I'm going to make you enough money to take care of all your expenses. If you spend less than 70% of what I'm making for you, I will grow your income every year. Not only that, I will make you enough or more in profits every year than you're paying me. So you're basically getting me for free and you're making this much money instead of what you're making now. And that was the gig. And that's what I'm still doing today. Way back in 23, I sold my business. I wrote this book and a year later, I started a community of people who it was a coaching business, and it morphed into this community where I do the coaching, all of them at once, through Q&As and things like that. And it's just been a trip. It's been a great time to see people saying how much different 2025 was from 2024 before they read the book, before they learned this approach, how now how they retired earlier, retired 2 years before they were going to retire because they now had more than enough money to do that. This is very satisfying. So that's pretty much the story. That's what I do. I teach people how to get more money from their investments. Sometimes I coach them privately. Sometimes I do it in the group orientation. And that's it. I'm not writing any more books.
That's always a journey, right?
Yeah.
Is this something that you were passionate about or are passionate about? Or is this something that you just do really well? You just figured out a system. You're just like, hey, I'm
Well,
going to go for it.
I did figure out a way. It was totally different. I mean, when I first started working with this broker, he says, what do you mean you're going to sell and take those profits? People want to see profitable securities on their statements. I said, I don't think so. Rather think they'd see a line here that says you earn $20,000, and then they can decide where they want to spend it, where they want to reinvest it. Just the idea that your market value went up doesn't increase your buying power. You got to sell it to make it increase your buying power. Right now, the market, the S&P is at the same level it was, I believe, as it was in October today. The NASDAQ is where it was in September, and the Dow is below where it was at the beginning of the year. My portfolios are still generating the same amount of income. That's not changing at all. The income just keeps on. It doesn't matter the ups and downs in the market. If you're investing in these high quality positions, high quality situations that are paying regular income, and you trade them every now and then. There's 4 things that matter in investing. And I think it goes across the board, no matter what kind of securities. Quality of selection, diversifying amongst different sectors and different areas and so on, different names, income generation. And the final thing that Wall Street totally ignores, well, they ignore income pretty much too, but they totally ignore profit taking. And the main reason for that is they're afraid of lawsuits. Because when you're dealing with companies like Microsoft or NVIDIA or Exxon or one of those, and as an advisor, if you say, hey, John, take your profits. You've got a 25% profit here. Let's take it and put it in something else. That thing goes up another 25%. That sucker can sue you. You took me out of that thing. I could have made a lot more money. Well, he didn't know it. I didn't know it. But that doesn't matter. You can sue. So advisors generally don't take profits for people unless they're told to, and then they want it in writing.
Right, right, right. Wow, that sounds complicated. That sounds a little bit concerning. How did you get to that point where you're just confident enough to say, you know what, this is what we're going to do, and I'm going to stand behind it?
I guess it's experience with the parameters that I used. I wasn't chasing new issues. You know how they get all excited? Oh, this one's coming out. It's going to be better AI than NVIDIA is. It's going like crazy. Forget NVIDIA. You want this one? I didn't fall for that stuff. I don't care. I didn't know. I don't own any NVIDIA personally, no individual. I don't own individual stocks anymore. But I'd say, no, it's got to be in business for 5 years. It's got to pay me a dividend. It's got to be a diversified entity. It's got to have a lot of different things going on. That's what I look for. And I look for volatility, which is exactly the opposite of what anybody else wants. I want the market going up and down. When it goes down, it's an opportunity to buy if you're doing it with quality. And if it goes up, you take the profit and you move on. Or even you buy right back again. You can do either of those. About in the 80s, I discovered things called closed-end funds. And they weren't new. They were new to me. They were actually developed before mutual funds were developed in the early 1800s. And a lot of people say that it was in Europe where it was developed. But they are trusts. They're trust vehicles. And just like a mutual fund manager or an ETF entity has a lot of different stocks in one package or a lot of different bonds, they're the same, but their purpose is to generate income because they're pass-through trusts. And I don't know if you've done any estate planning or things like that yet, but these are trusts where the trust entity doesn't pay any taxes on the income it receives from the investment package because it passes it through to the beneficiaries and they pay the taxes. So that's what closed-end funds are. They're trust vehicles. So they have to pay 95% of their income to their shareholders. So that means two things. You get a lot of money. They cannot really be expected to go up in price a lot. Because think about it. If Amazon paid out 95% of its earnings, would it be the Amazon of today?
No.
There's a difference. It's designed to give me spending money. And if I choose to spend it, I can. If I choose to reinvest it, I can do that. So there's a difference. It's a different type of vehicle.
How long does it take to get to a point where, if you're starting from, and you'll have to let me know where we might start from, but, get from whatever point to a point where I'm starting to see reasonable returns, or I'm starting to see good returns, great returns?
Next month, I mean, if you took, let's say you have $100,000 in your 401k or your saving, your IRA or whatever, and it looks pretty when the market goes up, and it gets you all. You're losing sleep when the market goes down, and you take it. And you say, I'm going to put it in this stuff Steve's talking about. Well, as soon as I get you invested, you're going to start getting monthly income. And today's average yield on the securities I invest in is between 9 and 10%. And 9%, 10% annual. Yeah. And they trade just like stocks. And they own, instead of owning the Magnificent Seven or other types of securities, you still own them, but you own them in a package that's designed to get you income. So those guys, when NVIDIA goes up 20%, they're taking profits and they're sending them to you. And then they're buying NVIDIA again and doing it again. So it's a whole different mindset by both the manager and by the investor. You're there for the income. Your market value is not going to go crazy because you're getting all the money. So you have to it's more impacted by what people are talking about with regard to interest rates than what the stock market is doing. So it's a little bit different. But the interesting thing though is when you start thinking about, and most people only invest in stocks on the stock market, but as you get older and wiser, you start investing in bonds and preferred stocks and things that do generate income, but that are known to be safer. They're less risky. Bonds are less risky because if Merrill Lynch goes out of business, as it did in 2009, their stockholders get zip, nothing. But their bondholders may get some, 10% on a dollar, 10 cents on a dollar, or something like that. Bonds are therefore safer than stocks of the same company because they have they have to be paid first when some crappy thing happens. So bonds are an interesting investment. First of all, they're not liquid. They don't trade on the exchange. You can't go out and buy a 10% Citibank bond on the New York Stock Exchange. You got to go to a broker. He's got to see if he's got such a thing. And then he's got to figure out what price it is based on interest rates, and he charges a markup on top of it. Okay. So you get it. And then finally, your yield is based on your price. The good news is you get paid the same thing whether the price of that bond goes up or down. A lot of people don't, they tell you, oh, we got to sell you short-term bonds because they don't go up and down as much. That's just baloney. The longer the term bond, usually the higher the yield. And you always get the face value when it matures. But the thing is, there's a fee charge. So not only when you get it, you've already paid a fee. So with these closed-end funds that I'm talking about, you're buying it just like it was a stock. So if let's say I buy a package, a closed-end fund that invests in, what state are you in? You're in Georgia? I don't think Georgia has it. Well, you could probably buy Georgia state municipal bonds, but I don't think there's a closed-end fund. But let's say you were in New Jersey. You could buy a closed-end fund that owns only New Jersey bonds, municipal bonds. So not only is it tax-free federally, it's also tax-free in New Jersey, which is one of the highest tax rates, right? But when you buy that whole thing, you pay $3.27 or $15 per share. And there are no fees, there are no markups, there is no accrued interest to the last guy that owned it. You're not taking the piece of paper from him. You're buying a stock that invests in municipal bonds that are right now yielding close to 7% tax-free. So when I discovered that, I said, whoa, time out. I don't have to do all this talking and bargaining and wondering. I can just push a button or say, hey, Ken, go buy MMU, $6,000 worth of so-and-so. And I just bought them a portfolio of municipal bonds that are paying them tax-free income. And they don't have to wait 6 months to get it. They pay every month, a little bit every month. So it's a whole different type of security. And it's designed to give the investor, the share owner, income. It's not designed to go up in price and make them feel big. On the top of somewhere on my book cover, it says market value, the value of your securities, fuels the ego, makes you feel good, makes you feel like a big deal. But income fuels the yacht. That pays the expenses. And that's the whole mindset that I try to teach people. So don't just buy things because you think the price is going to go up, because chances are you're going to get greedy and you're not going to sell it. Like today, people are probably all ticked off because the market's gone down for a couple of days in a row and we're now down at October low. Why didn't I take my profits? Well, I took my profits. I was taking profits today. You know what kind of securities I was taking profits in today? The ones I just described, those municipal bond CEFs, because municipal bonds are Other than federal government securities, they are the safest of any, theoretically. And when we have problems in the stock market, people sell, got to go to something safe. So they go to municipals. And I was taking profits on them today because they went up.
So
So go ahead.
you can go in and out of municipals in the same way you go in and out of stock?
You can't in anything else but closed-end funds. You can't go out and buy one. Hey, I want to go buy some, Atlanta, Georgia healthcare supporting. Can't do it, pal. But within a closed-end fund, you probably own that municipal bond. And 300 or 400 different bonds could be inside one closed-end. So it's a different animal, and it's designed for income. And I call myself an income coach. That's what I'm all about, is income. That's what I want to do. What I want to do for you is I want to double your income. And to most investors, I can say that because most investors really have never thought about the income they're getting. They're thinking about the growth in market value. They want the market to go up so they look pretty. And they typically do not take any action when the market goes up, but they have no trouble being talked into selling when the market goes down. So most people have a nice, bright picture of profits. Then the market goes down and they wind up selling that thing for a loss.
So they're more reactive than proactive, I take it.
I wish I said that.
You wanna
Well,
say it? You can
well
have it.
put, well put, well put. Very well put. I like that.
Oh, man. It's interesting. One of the things, and, we talked a little bit before this show started is, um, retirement for business owners. You have a bit. I think, um, I'm sure you do too. There's no time that's too early. To start thinking about retirement. I think one of the things, as I'm listening to you, one of the things I'm curious about is, what is that time investment? So I'm gonna start thinking about retirement, and you're talking about the movement of stocks and bonds and all of that. But I'm a business owner. I don't know that I have time. I don't know that I have enough time to really be able to do what it takes to manage my portfolio.
Well, you can find managers who will do it that way. But yeah, when as I was a business owner, of course, I was in the business of managing money for other people, but I was running my own portfolio as well. I mean, the portfolio that got me out of the business in New York, I was still running that and I'm still running it today. But you find time to do it. And if it's absolutely impossible, you have to find a manager. And to find a manager who does what I do is difficult because it's not popular. It's on Wall Street. It's based on income, and most advisors they get paid on the amount of market value that they have, not on the amount of income they generate. So that's a little bit of a dilemma, that we're trying to change. We're trying to make people, particularly financial advisors, aware of the fact that they'll grow the market value just as surely using income-based securities as with the others, but it's a much more secure environment. And regardless of what happens in the market, their clients are going to be happy.
Is there like an amount of time, that it typically takes, to manage portfolio on a daily or weekly basis?
Yeah, I mean, I've been doing it for so long, it's kind of automatic for me. I spend when the market closes at 4, I'm usually upstairs getting ready for dinner by 5. And at that point in time, I'm checking the orders, what I put in for the day, and I'm actually preparing all of my sell orders for the next day. And then if de depending on what kind of cash I have, I can also do some buy transactions. I don't do them oh, I'm not trading while the market's closed. I'm just preparing the orders to go off when the market opens. And then if I haven't got all my buys in, I'll do that in the morning before the market opens. It'll take me about an hour, depending how good the market is, how much cash I have to spend. It could take me 15 minutes. That's plenty of enough profit. You hit the button, you sell it. It's just like that. You can manage it I travel all over the world. I manage it from everywhere. I was buying and selling just, last time we were away, we were in India. halfway around the world. I was still doing my trading. I mean, in today's world, you can do it from anywhere. It doesn't take a lot of time. The time is in transitioning. You got to take some time and know what you're doing, moving from one type of investing to the other. And it helps if you have a coach. You have a coach to do something like that, or it explains how to do it in the book. Oh yeah, you definitely have to have you sense, oh, this one's going up and it's going to keep up. I'm not going to sell it at 5% like Steve says I should. I'm going to hold on to it for a while. I'm going to hold on to it. And lo and behold, often it'll drop. Say, oh, it's going to go back up now. And then you're going to wind up, it's going to be back down there. But the other thing that people lose sight of, and I'm sure in economics courses and just in discussions with entrepreneurs, there's a thing called the velocity of money. And most business people, most entrepreneurs recognize that the faster they turn over their inventory, the more money they're going to make. So they might reduce their prices a little bit to get that turnover, right? So when I look at things, I say, I'm going to take at least 5 profits or at least 3, depending on the size of your accounts, in every account every day if I can. Because even if it's a 2% profit or a 0.5% profit, it frees up capital. If I have a $5,000 investment and I only take a $50 profit, I've got $5,000 to reinvest in maybe 2 or 3 other things that are down today because everything's down today. So I take that 5,000 up. I made money on it. And I go over here and I look at the list of things that are down today, 2, 3, 4%. I add a little bit to those, and it increases my velocity of money because next week when the market goes back up, it goes one way or the other. The next time it goes up, those things I just bought are going to go up, and I'm going to sell them. So the velocity of money is a very entrepreneurial idea. That's what it's all about. Even if it's a hardware store, hammers aren't selling. You price them down a little bit, maybe they will. Who knows? It's just whatever you're selling. Sometimes you have to put it on sale to increase that velocity. But yeah.
I guess so we talk about, the discipline that's required. What comes to mind with that, and in your description is setting up the guardrails. And so we have a goal. Whatever that goal is going to be, we have our guardrails for when we're going to buy, when we're going to sell, et cetera, et cetera. How does one go about?
That's a really, really good question. And having guidelines for your operations is very
Exactly.
important in any kind of business, right? So I have guidelines for the quality when you're selecting, when you're buying, what merchandise am I going to have on the shelves in my store? Am I going to get a bad reputation for having something that's not higher quality? I'm going to look at all the available closed-end funds out there and develop a universe that has every one of them's got to be in business for 5 years. Every one of them has to have at least 50 different securities inside. Every one of them has to pay more than 6% in distributions and has a pattern that it's been pretty stable. They all have to be volatile. I want them to show me that they've been going up and down for all these years that they've been in business, because that's how I make my extra money with the profits. So you have those guide rails. If I see something that looks pretty good, but it's only got 15 securities inside. I mean, there's a guy who operates within the same realm, and one of the things on his buy list but it's a it's a security that invests in just the companies in one country. So he's got this one country closed-end fund that he has in his universe of things he likes to use. But when you look inside, there's only one company. So it's the same as going out and buying a company that's in this country and say, hey, I got this much money in that one company. It's just like going back to the stock market again and accepting all the risk of a single entity. So that's why. And to me, I got to have 50 companies, buddy. If you don't, now, if you're a sector fund and you're only in the life and health insurance businesses, I might let you get away with 40 because it's a single sector. But if you're a general fund, you're going to have 50 and that's it. So those guidelines, those guide rails you're talking about are very, very important for comfort level. I mean, you don't ever want to go to bed at night saying, geez, what happens if the market goes down tomorrow? Or what happens if we have a 2008, a great recession? What happens? Well, with these types of securities, if you look back, you'll see that the income just pretty much kept right on chugging because they already own those bonds. And those bonds, there weren't a whole lot of companies that went bankrupt. There were some big names that went bankrupt. But if you owned a security that had 376 companies in there, unless it was a financial services industry when Lehman Brothers and Merrill went under, you probably didn't even feel a twinge when they went under. So the diversification is important.
Yeah. I've always heard that. I mean, I think I would run my companies like that. I never,
Yeah,
try to, fish all in a single pond just because,
there you
things
go.
happen. That makes total sense. It makes total sense.
I hear that analogy all the time when it comes to our diversification model. The more poles you have in the stream, the more fish you're going to catch. So what we've done and what our group of people are doing, we're not just using diversification as a risk minimizer, which it obviously is, but we've turned it from more than a defensive tool for risk management. We've talked it into an offensive weapon because we own everything. The universe is. I own over 250 different closed-end funds.
How is that an offensive?
Hmm?
How is
How's It's because if anything positive happens anywhere, like you could have a down economy, but some company gets taken over or they come up with a cure for cancer, what's going to happen in the health sector? Kabong! It doesn't matter if you're in a recession, the health sector is going up. So you've got stuff there and you're going to benefit when the prices go up. You're going to take your profits.
but you're
Oil,
but you're still, like,
it's,
buying and selling, like, within that sector, though,
I
right? So
am
you're looking at each sector and you're just saying, "Okay," same model you said,
right.
right?
I'm not leaving the model. I'm taking my profits and I'm going back in to that sector also. I'll add to positions that haven't gone up yet. Or if they're all up, I'll buy less than I usually do. So let's say you have a stock goes up to $40, you've made 20% profit, you sell it, and you had $10,000 in it. That's your normal investment. So I'll say, well, it's still top. I'm not going to buy it back because it could still continue, but I'm only going to buy $4,000 worth. So if it goes down, we had a crash next week, then I can get back, I'll add another 2,000 or another 2,000 until I get back to my 10,000 if that's my limit. You see, you look at, it's called market cycle investment management. Where are you in the cycle? Where are we in the interest rate cycle? Where are we in the stock market cycle? If everything is up in the stock market, pretty much everything, you just buy less of them. You don't stay out. If you stay out and we have a real rally like we had in 2021, you're going to be looking as the market goes up. You're going to hurt your neck as you watch those prices go up and say, "Oh my God, I don't have any of that because I didn't want to pay more." You don't want to have that feeling, so you just buy less of it. And then each time it goes up, you take your 10% profit, 5%, whatever your target is, and you do it again. You buy a little less. And in the stock market, there's always some downness. It doesn't go up for 37 days in a row. I think the most it's ever been is 13 days in a row. And that was in 87. January of 87, I think that happened before the crash of 87. But it doesn't happen very often. The more, like the days this one goes down now, the more likely is the next day is going to go up. It always bounces. There's one way or the other. So that's the market cycle investment management piece of running a portfolio. Where am I in the respective cycles? What's going to happen next? Nobody knows. You know where you are, but you don't know where you're going. So you react accordingly. You know you're high, you don't buy as much of something. You know you're low, yeah, then you buy your normal minimum. I usually start, I don't ever want to get as much as I get uncomfortable when I have as much as 25,000 in any one security. I don't like that. So I start very low in my portfolio. Different people have different levels where they feel comfortable or not. And in a program like what I describe to people, you can do your own thing. Steve wants to start at $3,000. I only want to start at $1,500. This other guy said, "Oh, I'm going in at 7,500." Whatever floats your boat. It's okay.
Nice, nice, nice. So you've got some tools that you've been putting together. You got your book, obviously, but you've got some other tools for folks that are moving in that direction, or you want to learn, or be in a community. You want to talk about some of that?
Yeah, the community, I think, has been I would say, the most productive thing I've done as far as my role as I guess my role now as an instructor, a helper, a coach. But the first year I coached, I got probably close to 100 different people that I spoke with and spent time with and sent on their way. But in the community, there's over 600 people that I'm in one level of teaching. I don't meet with as many of them personally, but we have these Q&As every week where different people, I see different names showing up all the time. And we talk about different subjects, different topics. And sometimes we just have this general, anything goes. You have any question about anything financial, throw it out there. We'll talk about it. So that's the community has brought that level of spreading the word. And then I try to explain to people that these closed-end funds, these are securities. And unlike ETFs and mutual funds, that have that fixed net asset value that's fixed to their value. The price is tied to the NAV. Closed-end funds aren't. Their price is based on supply and demand. So I tell them, the more people that you tell about this stuff that you're doing, the more demand you make for these things, the more money you're going to make, because they're not going to go down as much when the market goes down, because people that have read this and know this and have talked to you, they're not going to panic and sell these things because nothing goes wrong with them. They're going to keep them. So you're building a floor underneath what you make. So I encourage people, spread the word. We all make money if you spread the word, all of us. So that's that part of this. Of the thing. So that's one thing that I'm doing. And then another thing, and it's kind of exciting, and I think either next week or the week after, there's this college up in Maine that's going to be introducing a course that's based on the book and this process that you and I are talking about right now. And it's called the FIRE. It's a FIRE course. What's that? What does FIRE stand for? Retire early, financial independence, retire early. And a income machine that gets you there. That's kind of the name of the course. And they're going to promote it to their alumni because they're the older people, and to their current economics and business students. So that's kind of exciting. And that same course is available on my website.
Okay. Okay. And it just walks people through your process.
Yeah, it gives them some of the basic information. There's, several different PDFs that they can read and get a feel for it. Of course, the textbook is Retirement Money Secrets. They got to read that, or else, and then it takes them through all the different, like 14 different chapters, 14 different groups of lessons, and it has some stuff to read, and it has a Q&A on that topic, like typically an hour Q&A on things around security selection. When do you sell? How do you diversify? How do you use those universes of securities? How do you know which one to buy? It's all that information put together. And when they get done, they got a choice. They can just do it themselves on what they know, or they can join the community and get more education. There's actually more educational value within the community. There's more Q&As than we could put in just that resource. So you just have to choose. People have different, whatever, they might have more time to take a course online to actually get involved in a community. Just like a lot of people will use the Audible book rather, because they drive to work and they do it while they're commuting. They listen to it rather than get a hard copy book because they don't have the time to sit down and flip through it. So, I mean, almost 10 or 15% of my book sales are Audible books. It just hit 1,700, which was just pretty good for an Audible book.
Yeah. Yeah.
The book itself has gone over the 10,000 mark.
What? That's excellent.
Yeah.
Congratulations. That's excellent. That's excellent.
Thank you.
Last question for you. So, name of the show obviously is The Relentless Pursuit of Winning. And we all define winning in whatever way we want to. So, the question I always ask my guests is what do you recommend to people to maintain that relentless pursuit, regardless of what's happening in their lives?
Well, it's never been a problem for me. I don't know if it's genetic or what, but I've always had that motivation to keep on keeping on, to just do it. And I think when it comes to money and it comes to income, once you start making a growing stream of income and you develop 2 streams of income like we have with what we're doing with the regular distributions, people are starting to call them snowstorms. Or blizzards of money coming to my account the end of every month, when you start feeling that and you start seeing your income growing every quarter, it motivates you to keep on going. It does. I know it motivates me. I don't look at numbers very often, but religiously, the end of every month, I want to see that amount, the capital I have invested, the base income that it's producing, and the projected income for the next 12 months, those 3 numbers better be going up every quarter. That's what I'm after. And that in itself gets people motivated. Believe me, I've seen it. They just really like that happening. And I think they also really like to know that when, their wife says, "Hey, why don't we go to the islands this winter?" And they can say, "No problem, dear. How much do you need?" I think that's the motivator to keep on going.
Yeah. Yeah. That would be that'd definitely be a
And
motivator.
you can take about, and you probably have children or grandchildren, maybe children
Yep.
that are college age.
Yep.
I mean, think about that. You get enough income coming in to take care of that tuition. That's important. That kid's getting out of college with no loans. I got a granddaughter right now that's been accepted at law school, which is a scary amount of money. Hopefully we'll be able to say no college loans when that gets done. But those are the things that motivate people, I think. Particularly this is a no-lose type. There's nothing bad about there's just no negatives in this process that we're talking about. It's all positive. It's not like a lot of people used to say to you, well, for every time you take a profit, somebody's taking a loss. There's no such relationship. That doesn't exist. What you're doing is good for you, and it's good for everybody else too, because in this scenario, we all own pretty much the same securities. I'm going to sell it. I'm going to take the profit. I'm going to buy it back again, probably the next day, if I can, so that there's no big down and up type thing. It's all stable, and we're just growing the number of people involved. That's what's happening here. But yeah, I think that's the key in my profession, in my area of expertise. That's what keeps it going. And I'd like to see more people be able to do what they want to do. There are some people, we're just talking about tax time and things like that, and some people say, well, I like to reduce my taxes by making donations. If you're making twice as much money as you used to, you can do twice as many donations. So it really feeds everybody's, I think, just, it is important. I don't think it's important in the sense that you want to, do certain, there are people that take advantage of other people to make money. I don't think that's the case with this type of thing. There's no losers in this, and I think that's important to me. That's important. You're welcome. If you want, I'd be willing to make an offer to your listeners.
I'd love that. Yeah, please do.
If that the course we talked about, which is the FIRE course to learn about income investing, 25% off to anybody who tells me they came from this program, from this interview with you. Okay? They can buy it and then contact me or contact me first, whatever, but they'll get 25% off.
Okay. And where do they go to get that?
To my website. My website is theincomecoach.net.
Easy. Okay, we'll make sure that's in the show notes as well. So anybody that goes and sees the show notes, they can grab that.
No limit, not just 25 people or 50 people. Anybody, anytime. Contact me first. I'll make the arrangement, and I'll put you in touch with the person that collects the money, and she'll get you in 25%.
Fantastic. I will spread the word. Hopefully we can get you, hopefully get a bunch of people in the course, in the program. Well, thank you again. I really appreciate it. Enjoyed it.
Okay. Well, Rick, it's good talking to you.
You as well. And folks, thank you so much for watching or listening to another episode of the Relentless Pursuit of Winning podcast. Catch you next time.